Good evening, ladies and gentlemen, and welcome to the Q4 FY25 and FY2025 earnings conference call of Tata Chemicals Limited. Please note that this conference is being recorded. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. We have with us today Mr. R. Mukundan, Managing Director and CEO, and Mr. Nandakumar Tirumalai, Chief Financial Officer of Tata Chemicals Limited. Before we begin, I would like to mention that some of the statements made in today's discussion may be forward-looking in nature and may involve risk and uncertainties. With this, I now invite Mr. R. Mukundan to begin the proceedings of the call. Thank you, and over to you, sir.
Thanks, Nirav. Good evening and welcome to everyone for this Q4 FY25 earnings call. And I'll start the discussion with a brief industry overview, then move on to our highlights across business and geographies. Starting with the demand scenario across geographies, the demand worldwide, there was a surge, there was a growth, mainly led by China by 18% and India by 4.5%. The market conditions, while the rest of the world saw a very muted growth or decrease in demand of about 2.3%, the market conditions remain challenging, even as India continues to grow, while China, US, and Western Europe are either seeing flattish or slight decline due to reduced demand, mainly in the flat and container glass in all these markets. So going forward, we do anticipate that pockets beyond, other than China, US, and Western Europe to show momentum and growth, and India will continue to grow. Though demand-supply balance softness, tariff uncertainties will also weigh in on the market. But however, I would say looking beyond this, medium and long term remains positive, driven largely by sustainability trends, where soda ash is one of the key ingredients for the sustainability transition of the world. In terms of supply side, so soda ash remains well supplied, and mainly the supply position will continue to remain strong, especially because supply has risen in China more recently. Soda ash capacity increased by 8.9%, and this was the main reason for decline in prices by over 25% from previous year. The tariff uncertainty could lead to shifts in production center of soda ash application industry, and this could lead to change in demand centers. However, some of the demand centers will continue to move forward with positive momentum. In terms of the TCL performance, the company reported for Q4 a consolidated basis a revenue of 3,509, EBITDA of 327, and a PAT before exceptional item of negative 12 crores. For Q4 financial year, on a standalone basis, on a revenue of 1,219 crore, there was an EBITDA of 230 crore and a PAT from continuing operation of 97 crore. For the full year, the consolidated revenue was 14,887 crores, an EBITDA of 1,953 crore and a PAT before exceptional item of 479 crore. Similarly, for FY25, the standalone revenue was 4441 crore, EBITDA of 818 crore and a PAT from continuing operation of 524 crore. India, the performance is higher compared to previous year, mainly driven by higher volume, partly offset by lower realization of soda ash and bicarb. The quarterly sales volume of FO has increased significantly to 817 metric ton compared to Q4 of FY24. During the year FY25, company commissioned 230 kilotons of soda ash, which is fully on stream now, and 140,000 kilotons of bicarb capacity in Metapur, which is also fully on stream. US overall, both the volumes and prices were lower than Q4 of 24 in FY25. UK had lower volume mainly because of the key reason of decommissioning of the ceasing of the soda ash operations in Lostock. And there's been an exceptional charge, additional exceptional charge of 55 crore, which has been taken to comply with certain regulatory and contractual obligations in UK. And our focus in UK will be to move fully to high-grade value-added products. And in this regard, we have commissioned a 70,000 kilotons of pharma salt capacity in Middlewich, UK. Kenya saw higher sales volume and higher realization, mainly because they continue to focus on the domestic African market, which gives them better yield in terms of price contribution margins. Rallis results were lower amid continued weakness in export market, and this also is a weak quarter for Rallis, and they were in line with our internal understanding. In conclusion, going forward, I think our focus will continue to be focused on safety, focus on sustainability. While focusing on these two, we will continue to focus on maximizing volumes across products, focus on cost and working capital efficiency, and we will also calibrate capex to the market conditions. We remain positive in terms of the medium-term outlook, and we also remain very focused on our outcomes in the immediate term to ensure that our free cash flow and operational efficiencies continue to be of the highest order. With this, I close my comments and hand over back to the moderator to open for Q&A. Thank you.
So shall we open the floor for questions?
He was asking something.
No.
Q&A.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Participants are requested to limit their questions to two per participant and can rejoin the queue in case of further questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Saurabh Jain from HSBC. Please go ahead.
Yeah, thank you so much for the opportunity. My first question is on the Indian business. We have seen improvement in the volumes and also on the margin side on a Q&Q basis. I wanted to know your views whether the government imposed minimum import price, does it play a role in this kind of improved performance for us during the quarter?
No, I think this would have been done even without any support, and I think that MIP was in fact not a factor at all.
Okay, so it's going to expire in June, and how would you imagine the situation in India post this MIP expiry? You said you are not impacted by it, but what about the industry? Are you seeing any impact post this expiry of MIP next month?
I doubt it benefited industry. I doubt it's going to sort of impact the industry.
Okay, thanks. Secondly, on the US business, and if you can also comment on the margins for the other businesses as well. The US business, we have seen the margin, kind of seeing persistent compression, right? While if I look at the realizations, it's still holding up at about $259 to $60. And we used to make good margins at these realizations about 2 to 3 quarters back. Can you please explain what kind of led to such kind of difficulties in getting the profitability in the US business, please?
I think the big issue in US is not mainly the domestic piece of the US business is doing fine in terms of the both revenue and margin profile. It is mainly in the exports where there's been a margin compression, and I think fundamentally one needs to watch out for the export pricing in the Southeast Asian markets and in the Latin American market. Latin American market not such a big issue. It's been the Southeast Asian market where the prices are hovering somewhere close to, I would say, $200 odd per ton, and they are not while they're positive contribution margins, but they are not full cost recovery.
So what you're highlighting to the fact is that the demand situation is much better in the Latin and the South Asian markets, but the pricing challenges remain. And the margins are not as good.
I don't think there's a demand issue in the markets we operate. I think we are fully sold out and we'll continue to be fully sold out in all our products. I think as far as, and I think the way we do see the next year going forward, we do see India, Kenya and the UK continue to move in the positive direction. UK mainly because they've restructured their operation, and I think the cost structures and everything will be reflected by first quarter, and you would start seeing the difference. And by second quarter, it would have fully settled down. So I think that's the profile I would say of UK, because whatever residual issues would be there, they would all be out of the way during, I think, early part of this month itself, more or less it was out of the way. So I think we are not going to see any further cost impact, and UK would continue to go towards a value-added cost profile, which is what India would continue to move in the same direction, and Kenya would be. And US domestic also should be positive. I think the main point being the US exports, which we remain totally focused on how to improve the volume and the market mix, and that effort the team is going to work on. It is not that we can't place the volume, but it is about where can we place the volume with opportunities to improve the margin profile.
So what could be a fair assumption to kind of build out the margins for the US business? $40 per ton of margin, when can we reach that back?
What is the question? Just repeat that.
What I'm saying is, what kind of improvement do you expect in the US margins in the next few quarters? How much of that can improve?
See, if you look at the next few quarters, the pricing is still subdued in the market here. So I think we'll have to look, and since US exports about 60% and 40 is domestic sales, on the export part, the pressure still remains. So we don't expect any major improvement in the margins the next few quarters in US.
Thank you. Saurabh, sorry to interrupt you. I'll request you to come back for a follow-up question.
Sure, thank you.
I request to all the participants kindly restrict to 2 questions per participant and join the queue again for a follow-up question. Next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. I hope I'm audible.
Yes, sir, you're audible. Please go ahead.
Yeah, great. Thank you. So, first question on the UK part of the business. You did mention, one-time cost or expenses of around 55 odd crores for the quarter. But even if I adjust for that, the profitability on the business, given the shutdown of Lostock there, looks slightly on the lower end. So your thoughts on how you are looking at FY26, given that pharma salt also comes into picture in terms of ramp up, and the loss-making operations are also taken care of.
Yeah, I think as I said, by Q2 you would start getting the complete stable profile, and our anticipation is in terms of its overall, it should move towards the way Magadi transformed itself. So I think UK is on a transformation path. We're pretty much hopeful that will be the direction it would take.
Sure. And Nandu sir, just as a follow-up, show any numbers or thoughts we can peg ourselves to, maybe an FY21-22 profitability, sort of a number that we can look at on a steady-state basis?
If you look at the British Salt numbers have improved in the last 3-4 years' time, and therefore when you get the annual report, let's say by the end of May, you'll get all the numbers for company-wise performance. And then you can look at those and work out. So British Salt is an upside, and I think EBITDA is in the last 4 years anyway doubled. That would remain as a time. We also get the incremental volume from the pharma grade salt, and Bicar, the 80 KT plant remains in UK, which is going to deliver profits. Lostock is shut down, so Lostock losses will not be coming going forward. So broadly, we're looking at a kind of a UK getting into a much better financial position going forward. The issue remains debt in UK, which has to get serviced over a point in time. So I think broadly it's a British Salt and the 80 KT Bicar which will do well.
Okay, great. That's helpful. Second, on the Kenya side of operations, we have seen a recovery in profitability there. Volumes also have seen a Q-on-Q improvement as well as on a Y-on-Y front. Will this be a fair run rate expected to continue, or there are more benefits that can flow through there?
Yeah, in Kenya, I think this would continue. I think there is headroom to improve volume even further. That will be our attempt. But I think the current run rate is a fairly conservative estimate you can make. In addition to that, they've got an approval to expand their capacity from the government. The NEMA approval has come this quarter, and they are pressing ahead with the expansion initially for another 50,000 ton. But this 50,000 ton will be a pure ash product, which means it can go into float glass. And we expect to bring it on stream sometime towards the end of the year. That will be another added benefit as we move forward in Kenya. And the pure ash product, at least the construct we have is it will come in streams of 50,000 ton because it is a very modular plant which uses green power and solar power. Thank you.
Okay, great, sir. That's helpful. Thank you and all the best.
Thank you. Next question is from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity. So first question is in terms of the Chinese demand. So we have seen that last year also it went up by double digits. For 3 months also, in your commentary you said almost 18%. So any understanding as to which segments are driving this demand? And probably at certain point in time, there could be a backlash in terms of the user segment. There would be higher inventories and subsequently demand slowdown for soda ash. Just your comments on that. Thank you.
As I mentioned, the last year was a year of very strong growth in China. We don't expect a similar growth to continue this year. Last year was about 18% surge by mainly solar and lithium carbonate markets. We don't expect, because usually we expect about 6% growth. So we are actually factoring in that China will probably remain stable or maybe have a negative of 1% or so. So it's going to be somewhere stable in my view. So that's what we are projecting into our plan.
Sure. Thank you. So second question, in terms of the India domestic market, how are we foreseeing both the availability of soda ash in the domestic market and the exports, and concurrent demand side, which and all segments are actually showing good traction? Thank you.
India will continue to grow, and we are seeing a very good traction of growth in both glass and all other segments in India. And we are at least factoring anywhere between 5 to 6% growth in India even in the coming year. And Indian economy and Indian demand is one of the steadiest we will see for the next couple of years.
Sure. Thanks and all the best, sir.
Thank you. Next question is from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Thank you and good evening. So if you were to look at the UK business in perspective, if you were to knock out the soda ash revenues and work on the margins, is a 20s kind of margin possible once everything is stabilized, maybe second half? What is your thought on that?
I think my suggestion is once we stabilize, I said, second quarter is what you should take. First quarter, I think, will be the continued process stabilization. The reason I say that is we will be finishing the reconfiguration of our power plant and other plants, because these power plants were sized for a very large capacity of soda ash. They're being reworked and reconfigured. That work should sort of stabilize around second quarter. So just I would say I don't want to make any forward-looking statement. I think you need to wait for the second quarter numbers to come through. Part of the result you will see in this first quarter itself. By the time second quarter comes, it should stabilize more.
Okay. So in terms of the US business and the overall interest expense outlook, in terms of the cash flows, when do you see the cash flows improving to levels where you can reduce the debt and bring down interest expense? And obviously, you need to see some traction in terms of the pricing. But at these prices, would you expect the current run rate in the US profitability to continue? Or do you have any other levers where you can at least marginally improve the performance?
Yeah, in terms of US, our focus is going to be to generate enough EBITDA margin and cash flows to at least start bringing down the debt marginally. So we are extremely focused, and we have actually tightened our belts in terms of, when I said recalibrate the capex plan. I think the bulk of the recalibration in capex is happening in US as we speak, and we'll be able to grow the momentum in US as soon as we see that it has reached reasonable levels of free cash flows, which then can allow us to invest. So we are putting capital where the cash flows are good, and where the cash flows need to improve, we will work on improving them. One of the big levers we have is to become even more cost efficient and cost competitive, and that effort is underway during the year. So you'll start seeing some of the results on that. Even while the market remains challenging for the US exports, you will start seeing the results during the course of the year.
just one last thought. If you look at the excess capacity plaguing the market, what is the kind of capacity that needs to be taken out for you to get back to normalized margins?
See, the excess capacity, I would say not excess capacity, excess uncompetitive capacity, I think, which needs to go off for the balance to happen. I think if you look at the world prices, the highest world prices in Western Europe, I think the capacities there are being serviced at unsustainable levels, and ideally they would be the ones. Also, in these sort of markets, we expect the new capex for synthetic to sort of slow down, and that would also make sure that as growth comes in, demand growth continues, we have a reasonable balance coming through. So broadly, I would say that in the markets we operate now, we are not an operator in the European market. For us, we work with a pretty stable outlook towards capacity and continued growth of the market. The balancing in Europe will only take out some of the material which flows out from Turkey into Europe. That will continue to increase. That's our view.
Okay, thank you very much, and I'll join the queue.
Thank you. Next question is from the line of Vivek Rajamani from Morgan Stanley. Please go ahead.
Hi, sir. Am I audible?
Yep.
Yeah. Thank you so much for the presentation, sir. Just a couple of clarifications on the US. I know you mentioned that the export realizations in some markets were the main reason for the decline in EBITDA, but just wanted to check if the surge in gas costs that we saw this quarter, did that also play a role in the margin compression? And the second clarification I had was, if I remember correctly, in the last quarter, you mentioned that 2 shipments got pushed out to this quarter. So just wanted to check if it wasn't for those shipments, would the US volume numbers would have been lower this quarter? Thank you.
Yeah, I think the US volume numbers are lower this quarter, mainly because I think we had congestion at the port of Portland because of weather condition, and they did get pushed out. So they will come into the books in the first quarter of the current financial year. And in terms of your question about, sorry, can you repeat the first question? What did you ask before that?
No, yeah, just wanted to check if the increase in gas cost, did that also play a bit of a role in the margin compression?
Gas is fully hedged. I think our big issue, more than the cost side in most of the units, variable cost side, it has more been the market pricing and also fixed costs where there are opportunities. So I think we are focused on those two elements. US, in fact, our gas consumption is only 25% of our energy portfolio there. 75% of our energy portfolio still is coal, and while we will convert to gas fully by 2030, as we speak, 70% is coal, which is more or less stable. There is no movement in the cost at all. So for us, the impact is not high, and that has not made any difference. Our biggest difference is as Nandu highlighted, we need to maximize volume. Maximizing volume does bring down variable costs because the utilization rates aid efficiencies of operation. And the second piece is about making sure our fixed cost is fit for fitness. There are opportunities there. And also markets we serve, can we get to slightly better servicing of markets where the profile market mix is better.
Sure, sir. So just as an extension to that, because you mentioned the logistical problem, then would a 600 kilotons sort of a quarterly run rate be a realistic number to assume going forward, assuming you don't have any other constraints?
For US? Yeah. It should be very much possible. I think we are also in the process of adding warehouse capacity so that the production rates and evacuation rates don't get affected. So we will be doing that to aid a steady production. But 600 on an average should be very comfortable.
Sure, sir. And if I could just squeeze in one last clarification. I think in your opening remarks, did you mention that there was supply growth in China once again? Did I hear that correctly?
Yes, in China, there's been a supply growth. I think that is where the capacities have come in last year. And basically, the Inner Mongolia capacity was not running at full rate, full capacity due to maintenance outage, but now it is fully back on stream. So the maintenance.
So apart from the Inner Mongolia capacity, sir, there is nothing incrementally new, right? It's just the ramp up of that capacity. Is that correct?
Yeah, basically they're out of the maintenance outages, which is why I think the exports to China stopped.
Just wanted to clarify that. Thank you so much, and all the very best.
Thank you. A request to all the participants, kindly restrict to 2 questions and join the queue for a follow-up. Next question is from the line of Arjun Khanna from Kotak Mahindra. Please go ahead.
Thank you for taking my question. Sir, when I look at our net debt, it's up roughly 1,100 crores. And in the presentation, we talk about net debt being higher due to higher working capital debt in India, US, and UK. But when I look at our balance sheet, I do see inventories up only 30 crores, trade receivables being flat at 1,900 crores, and trade payables actually in our favor of around 120 crores. So what am I missing here?
Arjun, I think it's more in terms of we also had a capex incurred during the quarter, so I think temporary funding for the year for capex, and this year we had, I think, peak capex in India and all over the place. So that is a temporary working capital loan taken to fund the capex, but over a point in time that will be repaid from our equity coming in terms of the profits being made. So otherwise, the inventory is more or less intact. It's more like I would say UK had also certain expenses, the variable cost being more. Otherwise, it's more in terms of funding the overall cash needs of the company, which came in the year, which EBITDA was there, but it was offset hugely by the capex incurred. And at the last stage, because this capex was mainly incurred for the last stage of Mithapur, which had the capitalization happening for soda ash, bicarbonate, salt. So it's a matter of temporary funding taken through working capital route.
In terms of capex, so we spent roughly 2,000 odd crores in FY25. What is the outlook for FY26 and beyond, if we have any number for 27?
It will be lower because this year was a peak, Arjun. As we spoke about, the UK pharma grade salt was capitalized the current year, the salt and bicarb came. So this is a peak. We'll go back to the historical trends going forward, that is for next year.
So our plan would be about 1,000 crores for FY26?
See, our sustenance capex should be clocking anywhere between 550 or so, 550, 600 or so. And beyond that, I think our biggest capex is increasing the capacity in silica plant. Our FOS prebiotics plants at the cost of about 18 crores. And there are no other major capexes being planned during the year. We'll come back to
Kenya, sir?
Kenya is
50,000?
Yeah, that is at a very minor capex. We'll give you the figure in the next meet when we do. It is about Kenya is about next year is about 60 odd crores
for 50,000 tons.
Yeah, 50,000 and other capital expenditures. Yeah.
Sure. And my final question, second question on freight costs. So if I see freight and forwarding costs year on year, while we have increased volumes by roughly 1% odd, we see 11% increase in freight and forwarding charges. Is there any one-time impact on this, or is there anything you'd like to call out on this number? So is it a big change, etc., the way we do business?
Yeah. One is increased volume we had in the current year, Arjun. And secondly, we look at the increase also this year. We're getting out of ANSAC in the last year of ANSAC, and which means that now we have to directly get the, let's say, C&F price and pay the freight for it. Till last year, we had ANSAC a much higher share. We were delivering at their port in US, and they were incurring the freight. So the model has changed in US, and this is the third year and the last year of ANSAC coming out. Next year would be entirely exports without any ANSAC play. So that's a change in model, which means now we get a higher revenue, but we also incur higher freight.
Sure, but net, would it have a positive impact on margins?
See, that we can't say between ANSAC and export, both would be more or less similar. But in the non-ANSAC case, that is, we'll know who the customers are. At this point in time, I think premature to comment on whether I'll get better margins by doing non-ANSAC sales, but broadly it should help us in the long term. Because now we know exactly who the customers are and we can service them better.
Sure. Thank you very much for this and wishing you all the best.
Thank you, Arjun.
Thank you. Next question is from the line of Abhijit Akela from Kotak Securities. Please go ahead.
Yeah. Good evening, gentlemen. Thank you so much for taking my questions. Sir, in your opening remarks, I believe I heard a number of 8.9% increase in capacity for soda ash for the full year last year at the global level. Just wanted to confirm that number, and then if you could please also just help us with a demand growth number if you would happen to have that for last calendar year as well.
So last calendar year, I think both were about similar. I think 8.3 and 8.9. So I think the demand grew by 8.3 and the supply which came on stream was 8.9.
Understood. And with regard to the outlook for capacities in the global market, would it be possible to share your perspective on how you're seeing things? You know, there is a large capacity expansion by Shisha Jam, I believe it's called, in the US, 5 million tons odd, and then some other, smaller expansions in various parts of the world. So any sense of how much, new capacity could be expected over the next 2 or 3 years?
Our view is that expansion in US for export market is unviable at these prices.
Yeah, that's.
I'm saying that at the current export price realization and margins, the expansion of capacity is not viable. And the point is that at the end of the day, you have to finance these. It won't be. Numbers don't add up.
Understood, sir. But as per your market intelligence, are the suppliers in the market behaving rationally according to this, or are the expansions still going on as per their plans?
I cannot comment on that. I can only comment on what we do. I think if you look at the market picture, it has become even more slightly hazy with all the tariff issues. And on top of that, interest rates are not coming down with the rate at which they need to come down. And I think if it is going to be debottlenecking, where you're adding capacity for very marginal cost, I think it is one scenario. But if it is a scenario of a fresh new capacity, I think it is challenging.
Okay. Thank you so much, and all the best.
Thank you. Next question is from the line of Dikshant Gupta from Jyotit Financial. Please go ahead.
Yes, good evening, sir. So, my first question would be, what exactly would you attribute the lower profitability to? Is it because of drop in realizations or increases in expenses or issues in the UK? What exactly would be the reason?
So clearly, I think pricing as a role, and secondly, I think this quarter some of the units could not perform in terms of volume, especially US. And thirdly, I think the issue is also due to certain one-off expenses which have been booked in this quarter.
Okay. And my another question would be, like, even the sales volume growth has not been very promising. So how will you maintain the sales volume growth in the future to offset the lower realizations or the volatility in the realizations in the future?
I think we will continue to maximize throughput. I think in terms of sales volume, if you look at it, I think the volume loss which we will have in UK in soda ash, more or less we'll try to compensate with growth in India and Kenya. And India and Kenya will continue to offer opportunities for expansion.
Okay. And will you be able to give a number, like how much sales volume growth would you expect year on year on a sustained basis?
See, the capacity has gone up in the current year, as is the numbers have been given to you. That will come for the next year full year. This year only part year it came. So you can expect that for the full year next year. Both India soda ash, India bicarb and UK pharma grade salt. That will be the incremental volume next year.
Oh, and that capacity increase would be, according to you, uh, it is met by the demand, like the demand growth also would be expected as much, right?
Yes.
Okay, okay. Thank you. Thank you so much.
Thank you.
Thank you. Participants kindly restrict to 2 questions per participant. Next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yeah, namaskar, sir, and thank you for this opportunity. Sir, firstly, can you provide us with the import number in tonnage for the quarter and for the year as a whole? As you mentioned that MIP did not play any role. So post the imposition of MIP, how have things been? And also an update on ADD, sir.
There has been reduction, but my views of that, and I'm giving my company view, that MIP number is not impacting. It's about 1 million ton of material came into India. But I think ADD, I think the investigation is on, so it is on. I would not like to comment on a matter which is in a quasi-judicial process.
Okay, and sir, for the utilization levels, what are the current utilization levels and what are the capacity addition for both soda ash, bicarb and salt? So if you could just give some color for the next financial year, how are the capacities likely to be, sir?
See, our numbers we have with you in terms of Tata Chemicals, that is there. And beyond that, capacity expansion is almost, look at US, very unviable. We don't look at much expansion coming on board, excepting China, which is already at the Inner Mongolia, is fully operational. Otherwise, we don't expect at the current prices that companies can put up capacities which will be viable.
That's correct, but I think the 2,000 crore capex which we have spoken for this financial year.
Yeah. I know you're asking about our capacity. Our capacity, as Nandu has already mentioned, 230,000 ton of soda ash and 140,000 ton of bicarb has fully come on stream. The full what you saw in quarter 4 will be now seen through the full year. That is the upside.
Okay, sir. Right, sir. I'll join the queue. Thank you, sir.
Thank you.
Thank you. Next question is from the line of S. Ramesh from Nirmal Bang. Please go ahead.
Thanks for the follow-up. So, if you were to achieve the full utilization of your expansion in Mithapur soda ash and bicarbonate, in terms of the depreciation run rate, would it be similar to what we saw in the fourth quarter for the full year, about 72 crores? Or should we pencil in some increase there? And on this sort of utilization, after the depreciation, would you be able to achieve the normal EBIT margin and ROC of around 20%? Is that possible?
Ramesh, we capitalized sometime in October, so this Q4 would be the right number to track for the full year going forward, quarter-wise.
So that entire 230,000 we can expect to be done in FY26?
Yes. And 145 KT bicarb.
Okay. So just some thoughts on the UK tariff rebates for Indian exports under the FTA. Any impact for soda ash, bicarbonate or any other business?
From UK, we bring in very high quality pharmaceutical grade products into India. Our exports to UK are not there, but I think certainly we are examining opportunities to export high grade pharmaceutical products once we start making in India to them. As of now, we don't manufacture. We make the pharma grades only in UK. But it's an opportunity to manufacture in India.
Okay, thank you very much and wish you all the best.
Thank you.
Thank you. Next question is from the line of Aditya from DB Securities. Please go ahead.
Hi, sir. Thank you very much for taking my question. So I had a quick question based on your initial comments. You said the number or the volumes are increasing on the India front now and other regions, right? Would it be enough to compensate for the decline you're seeing in other regions?
Decline of what?
In the sense that your decline in terms of the prices and your presentation says that some sort of a demand is tapering down in US, Europe, and China as well, right?
Yeah, so I think in UK we don't sell soda ash anymore. I think it's mainly the soda ash sold, which is bought from the US, which we sell to customers with whom we have contracts in UK. We don't manufacture soda ash. What I meant was the capacity which went out in UK will get compensated during the course of the year by India and Kenya put together. India has already added 230. There's another 50,000 ton which is coming in Kenya. So that should compensate for the loss of volume. So we'll be able to go back to our volume which existed when UK used to operate fully soda ash. In terms of bicarbonate, there is a minor reduction in UK of I think 40,000 ton, which we used to go to the flue gas treatment market. Because in India we've already added 140,000 ton. I think our net increase in bicarbonate will be 100,000 ton already. And salt, we have added 70,000 ton in UK of the high grade pharma salt, and our capacities in India are fully operational. And there's further expansion coming on stream, which we will review during the course of the year and come back to you.
So, just to follow up on that, would that compensate for any with increase in the production on the India side, right? Will it help us sustain the EBITDA above the last year margin, because it's now below 10%, right? And there has been a steady decline. I understand that the volumes are going up, but pricing pressure remains, right? If certain markets do well.
Correct. So Aditya, the pricing pressure remains, and I think what we've done is we've reconfigured our UK operation. That should be an upside next year. So that should fix, because our costs were high and we were having negative margins there. That is no longer there. And I mentioned that UK will transition to the same situation which we have in Kenya, which is a profitable unit. And our India would continue to. So you have 3 units which will be clearly in the positive zone. US exports remain a bit of a challenge, but we'll work our way through that through ensuring cost and operational efficiencies. So you could wait for the operational details as we move along, quarter 1 and quarter 2. That would give you an indicator of the way we are going to be transitioning into next year. The last 2 quarters are not a reflection of what the company is planning to do next year.
Okay. Sir, would you like to give some guidance on where the EBITDA margin should look like for FY26?
We don't give guidance, Aditya, but I think that's what I mentioned. As the year unfolds, by quarter 2, you would have a clear direction of where we are headed.
Okay. So just second last question, sir. With the tariffs coming along, right, do you see that because there is a clear pressure on China, do you see some of those export volumes might be given to us, or can we basically take advantage of that in case if there is a sustained pressure on exports out of China?
I think in our view, we have not factored any of the major issues around tariff. It may lead to rebalancing of supply-demand centers. And as of now, from the centers we manufacture, we have not seen a major shift in the way we need to rebalance our market portfolio. And we'll keep updating you every quarter, because this is a fast-moving situation, and we cannot project for the future. As we speak, our view is that our production center and market portfolio, we are not seeing any major shifts in the demand patterns as we see. But if there's a substantial change, we'll update you at the end of the first quarter.
Okay, sir. Thank you very much, and all the best.
Thank you.
Thank you very much. Ladies and gentlemen, we'll take that as the last question. I would now like to hand the conference over to Mr. R. Mukundan for closing comments.
Thank you. Thank you for joining the call today to all the participants. While the market conditions remain challenging, our endeavor is to excel in operations through innovation, digital, and customer delight. We continue our journey to embed sustainability, guided by Project Alingana, which the entire Tata Group is focused on. Our focus is to expand the core while being calibrated, and this will also include broadening the portfolio with high grade and high value added products. As highlighted in the previous calls, market remain range bound, and the pricing scenario would continue as it is, at least in the immediate term. We expect over a period of time the market profiles to change, and especially the positive benefits of sustainability as a driver will come into play. In terms of our approach, we would continue to focus on ensuring cost optimization and focusing on becoming more competitive. We will also be looking at ways and means to improve our capital program, including working capital, and we look forward to seeing all of you in Q1 of FY26. Thank you all, and safe days ahead. Thank you.
Thank you very much. On behalf of Tata Chemicals Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.